A Latin American and Caribbean property insurance market is facing a persistent decline in pricing, and there's little indication this trend will reverse anytime soon. But here's where it gets controversial. While prices continue to drop, the debate around policy terms and conditions is heating up, and many believe this is the next battleground for reinsurers and buyers alike. Industry experts based in Miami, including reinsurers and brokers, have recently shared their insights following the mid-year renewal period. They report that competition played a bigger role than expected, pushing prices down even further. This downward pricing movement has been ongoing since the sharp market corrections that began in 2022 and continued through 2023, signaling a sustained softening in the region's property insurance market. Alongside price reductions, insurers have revised contract terms, especially attachment points, which define the threshold at which insurers start to cover losses. In many cases, these attachment points have increased significantly, meaning insurers start paying out only after bigger losses occur. Looking ahead to 2026, it's widely anticipated that price pressures will persist, fueled by even fiercer competition among market players. A senior reinsurer executive in Miami described how the property market dynamics play out during renewals. Clients who waited until the last moment before the July 1st renewal deadline often secured better pricing deals. This waiting game suggests the market remains strongly buyer-favored for now. "I don't see this shifting anytime soon," the executive commented. "There's room to negotiate better rates for sure. However, changes to terms and conditions, such as attachment points, are still holding strong for the moment. But it's only a matter of time before they face pressure too, assuming the market remains profitable. Importantly, attachment points won't revert to the lower levels seen several years ago. They are likely to be squeezed slightly, but remain elevated compared to the past." Another reinsurance broker in Miami highlighted that leading reinsurers are more focused on maintaining their market shares than pushing prices back up. They want to sustain premium income even as rates soften, but acknowledge that rising competition, including new entrants from Eastern Europe and the Far East, poses challenges. The transactional nature of buyers in the Latin America and insurers currently have some margin to lower rates, so pricing remains the primary negotiation focus. However, once that margin narrows significantly, attention will inevitably shift toward renegotiating terms and conditions. These observations come amidst the backdrop where buyers in the region are enjoying better conditions than in recent years. After reaching a peak in 2024, pricing for property catastrophe reinsurance in Latin America and the Caribbean started to ease in early 2025, coinciding with abundant market capacity. This softening continued through major renewal dates including April 1st and the mid-year marks. According to Aon's mid-year renewal review on reinsurance market dynamics, reinsurance capacity in the region has grown substantially over the past year, from being just adequate to comfortably ample. This expansion of traditional treaty reinsurer interest, particularly for proportional coverage, intensified competitive pressures during the renewal season. Moreover, facultative reinsurance, where coverage is provided on a risk-by-risk basis rather than blanket treaties, also saw increased activity. Facultative capacity acted as an important supplement to treaty coverage, helping reinsurers manage risks that treaty underwriters avoided. Aon noted that while reinsurers were eager to deploy more capital in the region, buyer demand remained generally stable. Gallagher Re's own analysis supports this trend, reporting ongoing softening in the treaty reinsurance market through the mid-year renewals. They explained that cedents, insurance companies buying reinsurance, benefited from increased capacity and reinsurers' willingness to expand coverage programs. The extent of pricing reductions, however, depended on local risk exposure. Markets with high catastrophe risk experienced more modest discounts, while regions with lower risk saw more favorable pricing. Gallagher Re's Tom Wakefield pointed out that greater treaty capacity gave cedents the confidence to pursue growth and fill gaps in expiring proportional property covers. This flexibility is fostering more assertive underwriting and expansion across portfolios. Facultative reinsurance opportunities are becoming increasingly attractive, in the LAC region as reinsurers expand their appetite. Aon identified new market entrants and the growth of international participants as drivers of this trend. There's also growing interest in hybrid protections and facilities backed by facultative reinsurance, offering buyers more tailored risk management options. Gallagher Re similarly described the facultative market in LAC as increasingly dynamic, with traditional reinsurers and a rising number of managing general agents, MGAs, aggressively competing for business. As many of these players pursue rapid growth, a softening of original rates has been observed across various countries. So what does this mean for the future? Is the steady drop in property pricing a sign of a healthier, more competitive market? Or does it risk eroding reinsurer profitability to dangerous levels? Are the attachment point adjustments a fair progression or a silent squeeze on buyer coverage? And with new entrants shaking up the market's balance, how will established players respond? These questions are crucial to watch as the 2026 renewal season approaches. We invite you to share your perspective. Do you believe the LAC property reinsurance market is headed towards sustainable growth? Or are we seeing the early signs of a fragile, overly soft market? What role should terms and conditions play in balancing interests? Join the conversation and let us know your thoughts.